From our point of view, there was a lot of selling last week. And what we think is important about last week is we think when the Fed meets in September, they're going to cut 50 basis points because they really understood the message of the importance of confidence when we had that momentary yield curve inversion last week and the Dow dropped 800 points. It's a big deal, and the psychology needs to be maintained and actually improved.
From your perspective, how big of a deal was that yield curve inversion, as brief as it was? It was just by about a basis point or two here and there, and it didn't last long. Is this something that we should be noting as a possible indicator for a recession?
So it has been a good indicator of recession with a persistent inverted yield curve. Obviously, this was very momentary, but we think about sort of the self-reinforcing aspect of it and think about in the last hour how many people you've had on discussing the potential of a recession. That's the kind of thing, and we don't think that the elements are there for a recession because if you look at the numbers over the last several weeks, even confidence has started to stabilize somewhat. Mortgage refinancings are absolutely going through the roof. That puts more money in the hands of consumers. Productivity is nowhere near the kind of levels, it's actually been quite strong, that we typically see falling off before recessions. There isn't going to be a recession.
On the interest rate side of things, I know that you and many of your peers and colleagues are watching it closely. Do you feel as though we're in an environment right now where interest rates could fall substantially further from where they currently are?
No. In fact, we actually believe that in a lot of ways, you could call the interest rate environment, one of the greatest bond bubbles of all time. From our point of view, negative interest rates, there is an intellectual rationale around them. But in the end, paying a borrower to lend them money just really doesn't have long-term sense. And what we're seeing now over the last several days is the initial policy responses, the fact that the Treasury is talking about 50 and 100-year mortgages potentially, the fact that Germany is now talking about fiscal stimulus. We think that if people have an opportunity, the numbers make sense, to refinance their mortgage, and they don't do it now, they're going to look back in 6 months and wonder why they didn't.
How quickly could an unwind happen of haven assets to the downside? We've seen a surge in gold prices, Treasury prices, government bond prices in Europe. So how quickly would that fall off? How fast could they fall in price if things were to go back towards risk-taking? Well,
clearly a lot of it is dependent on, we're going to get an announcement on Huawei today. We have a September 1st deadline for potentially more tariffs. If you look at it the opposite, you plunge 50 basis points on the 10-year in a matter of weeks, it could happen that fast or faster.